Welcome to CMA USA Exam Coach. Alex here, and I'm excited to begin Section A of CMA Part 1 with you. In this section, we will learn about financial statements, and today we will start understanding financial statements and begin our first major one, the balance sheet. Let's break it down in simple words. Financial statements are like a report card for a company. They show how the business is doing, how much money it makes, what it owns, what it owes, and how strong the company is financially. And today we will start learning both what financial statements are and how the balance sheet works. A balance sheet gives us a picture of a company's financial position at a specific moment in time. It shows three important things: what the company owns, assets; what it owes, liabilities; the owner's value in the company, equity. Think of it like checking your own finances on one particular day, or so your bank balance, any loans you have, and the value of what you own. That is exactly what a balance sheet does for a business. So let's begin our journey step by step and build a strong foundation in financial accounting. Let's get started.
Financial accounting is simply the system a business uses to record and report all of its financial activities. Think of it like a diary of every financial event that happens in a company: money coming in, money going out, expenses, profits, investments, and so on. At the end of this process, we prepare reports, such as the balance sheet and income statement, that help us understand the financial health of the business. Why do we do this? Because many people rely on this information to make important decisions. Investors use it to decide whether they should buy, hold, or sell shares in the company. Banks and lenders look at it to decide whether to offer a loan. Suppliers and creditors use this information before giving goods on credit. Even employees and government authorities look at these reports for their own decisions. But remember, accounting information alone cannot answer every question. For example, financial statements can tell us that a company made a $1 million profit this year, but they cannot tell us what will happen in the economy next year, how political changes may impact the business, or whether the industry will grow in the future. So, while financial accounting provides very useful information, it works best when used together with other knowledge such as economic forecasts, political conditions, and industry trends. With this foundation in mind, we are now ready to continue building deeper understanding of financial statements, starting with the balance sheet and other key concepts. Now let's talk about who uses financial information and why it matters. Whenever a company publishes financial information, it must follow proper accounting standards like US GAAP or IFRS. These standards ensure the information is accurate, consistent, and trustworthy. Imagine if every company used a different method. We would never be able to compare one business to another. So, accounting standards create fairness and uniformity. So who actually uses this information, and for what purpose? First, investors use financial statements to decide whether to invest in a company, keep their investment, or sell it. They want to know if the business is profitable and financially stable. Second, banks and lenders look at financial reports before giving loans. They want confidence that the company can pay back debt. Strong financial statements increase trust, while weak financial results may lead banks to restrict or deny credit. Third, financial information helps identify strengths and weaknesses in the company. For example, the company may be strong in profitability but weak in cash flow. This helps both internal managers and external analysts understand where improvements are needed. Fourth, management performance is also evaluated through these reports. Good numbers reflect strong planning and execution, while poor results indicate challenges in leadership or operations. Finally, financial information is used by regulators to ensure the company is following laws and compliance requirements. This protects investors, the public, and the economy. So, in simple terms, financial information is not only a record, it is a tool. It helps businesses grow responsibly, helps investors make smart decisions, and ensures transparency and trust in the financial system. Now let's look at the different types of users of financial information. We can classify them into direct and indirect users, and also into internal and external users. First, direct users. These are people who are directly affected by the financial performance of a company. They have something at stake, usually money, jobs, or business relationships. For example, investors want to know if the company is profitable, so their investment grows. Employees want to know if the company is stable and can provide job security. Management uses financial information to plan and make decisions. Suppliers and creditors want to make sure the business can pay its bills. So, direct users are the ones who would feel the financial impact first if the company performs poorly. Next are indirect users. These users do not directly invest or work in the company, but they support or advise the direct users. For example, financial analysts look at financial statements and help investors decide whether to buy or sell shares. Advisors like consultants, banks, or brokers use financial information to guide their clients. Stock exchanges and regulatory authorities also fall under this category because they monitor and enforce rules to protect investors and maintain trust in the financial system. So, indirect users help interpret, evaluate, and regulate financial information. Now let's look at another grouping: internal versus external users. Internal users are people inside the company who use financial information to run the business efficiently. Management, for example, uses this information for budgeting, planning, and decision-making. They need accurate financial data to guide operations and strategy. External users, on the other hand, are outside the company. They use financial reports to decide whether they should start or continue a business relationship. For example, investors deciding whether to buy shares, banks deciding whether to provide loans, or suppliers deciding whether to give credit to the company. These individuals or organizations rely on published financial statements to make informed decisions because they do not have direct access to the internal records. So, in summary, financial information serves many users with different needs. Some are inside the company, some are outside. Some directly depend on financial results, while others analyze or regulate on behalf of direct users. Understanding these groups helps us appreciate why accurate and transparent reporting is so important in the business world. Now let's talk about the financial statements. These are the main reports a business uses to show its financial health. According to US GAAP, we have 5 important financial statements, and each one tells us something different about the company. The first one is the balance sheet. Think of this like a photo of the company's financial situation at one point in time, like taking a picture on December 31st. It shows what the company owns, what it owes, and how much belongs to the owners. Then we have the income statement. This one tells the story of how the company performed over a period. For example, over a year. Did it earn more money than it spent? Or did it have losses? So this statement shows revenues, expenses, and profit. Next is the Statement of Comprehensive Income. This one adds extra items that are not part of normal daily business. For example, gains or losses from currency changes or investments. It helps give a more complete picture than just net income. The fourth statement is the Statement of Changes in Stockholders' Equity. Don't worry, the name sounds long, but the idea is simple. This report explains changes in the owner's value in the business. Did the company keep some profit? Did it pay dividends? Did the owners invest more money? This statement tells us all of that. And finally, we have the Statement of Cash Flows. Even if a company is profitable, it needs cash to survive, to pay employees, buy materials, and keep running. This statement shows where the cash came from and where it went. It explains cash from business operations, from investments, and from financing like loans or issuing shares. So, in summary, the balance sheet shows where the company stands right now. The income statement shows how the company performed over time. The comprehensive income statement shows extra gains and losses. The equity statement shows changes in owner's value. The cash flow statement shows cash in and cash out. Together, these statements help us understand a business completely, its financial position, performance, and cash situation. Before we compare IFRS and US GAAP, let's first understand why we need financial reporting standards. Imagine if every company created its financial statements in its own way. One company might call revenue sales, another might include some expenses differently, and another might show profits in a different format. It would be almost impossible for investors, banks, or anyone outside the company to understand the numbers or compare businesses. This is why we need accounting standards, clear rules and guidelines that tell companies how to prepare and present financial statements in a consistent and understandable way. These standards make sure that the information is reliable and comparable. Now, there are two main sets of standards that companies follow around the world. The first is IFRS, which stands for International Financial Reporting Standards. IFRS is a principle-based system, meaning it provides broad guidelines rather than strict rules. Companies in many countries follow IFRS, and its goal is to give a flexible and open framework so financial statements reflect the true financial position and performance of the company. The second is US GAAP, or United States Generally Accepted Accounting Principles. US GAAP is rules-based, which means it has detailed instructions about exactly how to record transactions and report them. It is used by companies in the United States and by foreign companies that operate in U.S. financial markets. US GAAP is strict because it reflects the strong regulatory environment in the U.S., making sure companies are fully compliant with the law. So, in simple terms, IFRS is more flexible and focuses on the idea of fairness and transparency, while US GAAP is detailed and focuses on strict rules and consistency. Both exist to make sure financial statements are clear, reliable, and comparable for everyone who uses them. Now let's move on to our first financial statement, the balance sheet. A balance sheet is one of the main financial statements of a company. It shows the financial position of the business at a specific point in time, usually at the end of the financial year or a reporting period. It presents what the company owns and what it owes, along with the amount invested by the owners. In simple words, the balance sheet answers three main questions. What are the company's assets? What are its liabilities? And how much equity belongs to the shareholders? The balance sheet always follows a basic equation. Assets equal liabilities plus equity. This means everything the company owns is financed either through borrowing or through the owner's funds. Let's look at this blank balance sheet layout. As you can see, it is divided into two main sections. On the left side, we have assets, and on the right side, we have liabilities and equity. This format represents what a company owns and how it is financed, either by borrowing money or by owners investing in the business. Now, let's go step by step and understand each section in detail. First, let's begin with non-current assets. These are the long-term assets of a company, which means they are not expected to be converted into cash within 1 year or within the company's normal operating cycle. These assets are used for a long period of time to help the business generate revenue. Examples include property, plant, and equipment, which we often call fixed assets. It also includes intangible assets like patents, trademarks, and goodwill. Other examples are long-term investments or deferred tax assets. In short, non-current assets represent the long-term resources of the company, those that provide benefit for many years. Now, coming to current assets. These are the short-term assets that the company expects to convert into cash, sell, or use within 1 year or within the normal operating cycle. In simple words, these are the most liquid assets, those that can be quickly turned into cash. Typical examples are cash and cash equivalents, accounts receivable, inventory, and short-term investments. Prepaid expenses also come under current assets because they will be consumed within the current year. So, the key difference between current and non-current assets is the time period of benefit. If the benefit is expected within 1 year, it is a current asset. If it is expected beyond 1 year, it is a non-current asset. Next, let's move to the liabilities section. Just like assets, liabilities are also divided into non-current and current, We'll start with non-current liabilities. These are obligations that the company does not have to pay within 1 year. They represent long-term debts and financial commitments. Examples include long-term loans, bonds payable, lease liabilities, and deferred tax liabilities. So, any liability that is due after 1 year from the balance sheet date falls under non-current liabilities. Then we have current liabilities. These are the short-term obligations that are due within 1 year or within the normal operating cycle. These represent the amounts the company needs to pay soon. Common examples are accounts payable, short-term borrowings, accrued expenses, and current portions of long-term debt. Unearned revenue or customer advances also appear here because they need to be settled within the short term. Again, the difference between current and non-current liability is mainly based on timing, whether the payment is due within 1 year or after 1 year. Finally, let's talk about equity. Equity represents the ownership interest of the shareholders in the company. It is the residual value, meaning after all liabilities are paid, whatever remains belongs to the owners. The main items under equity include share capital, which is the amount invested by shareholders, retained earnings, which are profits kept in the business, and other reserves like revaluation reserve or general reserve. We can also have treasury stock, which represents the company's own shares that it has repurchased from the market. Treasury stock is shown as a negative figure under equity because it reduces the total shareholders' equity. So, when you look at the full balance sheet, assets show what the company owns, and liabilities plus equity show how those assets are financed. The total of both sides will always be equal. That is why it is called a balance sheet. In summary, the balance sheet helps us understand the company's financial position, what it owns, what it owes, and the value that belongs to its shareholders. Here is a sample balance sheet of a real company taken from the market. You can now see the actual figures and layout of a published financial statement. All the items we discussed earlier, like non-current assets, current assets, liabilities, and equity, are clearly shown here. This kind of practical example helps you connect theory with real-world reporting. For publicly listed companies, financial statements are usually available to the public through their annual reports or on the stock exchange website. You can easily download them and study the trend of assets, liabilities, and equity over different years. By doing this, you will get a better understanding of how companies present their financial position, how the numbers change from 1 year to the next another, and how analysts use this data to evaluate financial health. So, going through real balance sheets is an excellent way to strengthen your understanding of financial statements. So, we have seen an introduction to the balance sheet. Now let's dive a little deeper and understand it more clearly. The balance sheet is also called the Statement of Financial Position. Both names mean the same thing. It shows the financial position of an entity at a specific point in time. In simple words, it provides information about the company's assets, liabilities, and owner's equity on a particular date, usually the end of the accounting period. Unlike the income statement, which covers performance over a period of time, the balance sheet captures a single moment, like taking a snapshot of the company's finances. The balance sheet is very useful because it provides a solid base for several types of analysis. For example, it helps in calculating the rates of return, such as return on assets or return on equity. It also helps in evaluating the capital structure of the business. That means understanding how much of the company is financed by debt and how much by equity. And finally, it can help in predicting the company's future cash flows because the balance sheet shows what resources are available and what obligations must be paid in the future. Apart from these uses, the balance sheet helps users assess several important aspects of financial health. It helps in understanding the liquidity of the company, meaning how easily it can meet short-term obligations. It shows the company's financial flexibility, or how easily it can raise funds or adjust to unexpected changes in its operations. It also reflects the solvency of the company, which means its ability to meet long-term debts and commitments. And of course, it helps us assess the overall risk associated with the business. In financial statement analysis, The balance sheet is also used to measure the company's ability to pay its debts when they become due, and is to distribute cash to investors in the form of dividends or share buybacks, providing them an adequate rate of return. So, in summary, the balance sheet is not just a list of numbers. It is a powerful tool that helps analysts, investors, and managers understand how stable, flexible, and financially strong a company is at any given point in time. Now let's understand the elements of the balance sheet. Every balance sheet is made up of three key elements: assets, liabilities, and equity. These three together form the foundation of the accounting equation. Let's start with assets. Assets represent the resources owned or controlled by the company that will provide future economic benefits. In simple words, assets are what the company owns or controls that can help it generate revenue or value in the future. An important point to remember is that an asset arises from a past transaction. For example, when a company buys equipment or a building, that past purchase gives rise to an asset today. Also, the company must presently own or control that asset, meaning it has the right to use it and get benefit from it. And finally, the asset should provide probable future economic benefits. In other words, it should help the company earn money or save costs in the future. Examples include cash, machinery, inventory, and even intangible assets like patents. Next, we move to liabilities. Liabilities represent the company's obligations, that is, what the company owes to others. In definition terms, liabilities are future sacrifices of economic benefits that result from present obligations of the entity to transfer assets or provide services in the future. Just like assets, liabilities also arise from a past transaction. For instance, when a company borrows money from a bank, that borrowing transaction creates a liability because the company is now obligated to repay the amount in the future. So, a liability exists in the present, and in the future it will lead to a probable sacrifice of economic benefits, such as paying cash or delivering goods or services. Typical examples include loans payable, accounts payable, accrued expenses, and taxes payable. And finally, we have equity. Equity represents the net assets of the company, which simply means total assets minus total liabilities. It shows the residual interest, what remains for the owners after all debts are paid. For a business entity, equity is the ownership interest of the shareholders. It includes items such as share capital, retained earnings, reserves, and also adjustments like treasury stock. So, in summary, assets show what the company owns, liabilities show what it owes, and equity shows the owner's claim on the net assets of the business. Together, these three elements make up the balance sheet and keep the accounting equation in balance. Assets equal liabilities plus equity. Now let's talk about the golden equation of the balance sheet. This is the most fundamental rule in accounting, and it forms the base of all financial statements. The equation says that total assets equal total liabilities plus equity. In simple terms, everything that the company owns must have been financed, either by borrowing money or by using the owner's funds. That means, on one side of the balance sheet, we show the assets, what the company owns or controls, and on the other side, we show how those assets are financed, part of it through liabilities, and the remaining part through equity. This equality is what keeps the balance sheet perfectly balanced. If the company buys an asset using a loan, assets go up and liabilities go up. The balance still remains equal. If the company buys an asset using shareholders' funds, assets go up and equity goes up. Again, the equation stays balanced. So, no matter what transaction takes place in the company, this equation must always hold true. Total assets equals total liabilities plus equity. That's why it is called the golden equation. It is the foundation that ensures every balance sheet is accurate and in balance. Now, let's discuss the current and non-current classification of assets and liabilities. The main idea here is to separate items based on time. That is, how soon an asset will be converted into cash, or how soon a liability will need to be settled. Starting with current assets, These are assets that are expected to be realized in cash, sold, or consumed during the normal operating cycle of the business. The normal operating cycle is generally considered to be 1 year, but it can vary depending on the nature of the business. For example, most companies use a 1-year period, but for certain industries like tobacco, distilleries, or lumber businesses, the operating cycle may be longer because their production and sales processes take more time. So, assets like cash, inventory, accounts receivable, and short-term investments are usually classified as current assets because they will be converted into cash or used up within the operating cycle. On the other hand, non-current assets are those that are expected to provide economic benefits beyond 1 year or beyond the normal operating cycle. These include items like property, plant and equipment, intangible assets like patents, and long-term investments. Similarly, liabilities are also classified based on timing. Current liabilities are obligations that are expected to be settled within 1 year or within the normal operating cycle, whichever is longer. Examples include accounts payable, short-term borrowings, and accrued expenses. Non-current liabilities, on the other hand, are obligations due after 1 year, like long-term loans, bonds payable, and lease obligations. So, the key point to remember is, the classification depends on the time frame in which the asset is expected to generate cash or the liability is expected to be settled. This classification is very important because it helps users of financial statements understand the short-term liquidity and the long-term financial position of a company. Now, let's take a closer look at current assets and understand the different types with examples. First, we have cash. Cash is the most liquid asset. It includes the physical currency the company has, as well as balances in bank accounts that are readily available for use. Next, we have cash equivalents. These are short-term, highly liquid investments that can be converted into cash quickly without any significant loss in value. The key point is that their maturity period is usually 3 months or less. Examples include treasury bills, commercial paper, or money market funds. Then we come to marketable securities. These are investments that can be easily sold in the market. They can be classified into 2 types: trading securities. These are bought primarily for short-term profit. They are always current assets because the company intends to sell them within a short period. Other marketable securities. These may or may not be current assets depending on management's intention. For example, available for sale debt securities can be treated as current if the company intends to use them as working capital, regardless of their maturity period. Held to maturity debt securities are classified as current if their maturity is within 1 year or within the company's operating cycle. Next, we have receivables. These represent amounts owed to the company by others. They include trade accounts receivable, notes receivable, acceptance receivables, and even receivables from employees, officers, or affiliated companies, as long as they are expected to be collected within 1 year or the operating cycle. Contract assets are also classified as current assets when they are expected to be realized in the short term, usually in connection with revenue recognition from ongoing contracts. Then there are short-term notes receivable, promissory notes that are due within 1 year. Another important item is inventories. For trading businesses, inventories are usually finished goods ready for sale. For manufacturing companies, inventories include raw materials, work in progress, and finished goods. We also have prepaid expenses. These are amounts the company has paid in advance for goods or services that will be received in the future. For example, advance rent, advance insurance, or other prepayments that will be used up within the operating cycle. Finally, there can be funds that are restricted for current purposes. These are assets set aside for specific short-term purposes and cannot be used for general operations, but they are still classified as current because they will be used within the current period. So, in summary, current assets are all about liquidity. Assets that the company expects to convert into cash, use up, or sell within 1 year or the operating cycle. Understanding these items is crucial because they directly affect a company's short-term financial health and liquidity position. Now, let's move on to non-current assets. These are resources that the company owns or controls, but they are not expected to be converted into cash, sold, or fully used up within 1 year or within the operating cycle. In other words, these are long-term resources that will provide economic benefits to the company over multiple years. First, we have restricted cash for long-term purposes. This is cash that is set aside for a specific long-term purpose and cannot be used for regular operations. Next, we have marketable securities. These include stocks, bonds, and long-term notes receivable. Similar to current assets, marketable debt securities can be classified based on their intention and maturity. Available for sale debt securities are considered non-current if the company intends to hold them for a long-term period. Held-to-maturity debt securities with a long-term maturity period are also treated as non-current assets. Then we have long-term investments or advances. These are investments the company plans to hold for many years, such as investments in subsidiaries, joint ventures, or long-term loans given to others. Another major category is property, plant, and equipment, or PPE. These are tangible, long-term assets used in the company's operations, like buildings, machinery, vehicles, and furniture. PPE is used over multiple years and is gradually depreciated to reflect the usage of the asset. We also have right-of-use assets obtained through lease agreements. When a company leases an asset for a long term, it recognizes a right-of-use asset on the balance sheet, representing its control over the leased asset during the lease term. Next, intangible long-term assets are non-physical resources that provide long-term benefits. These include patents, trademarks, copyrights, software, and goodwill. Then there are long-term prepaid expenses and receivables. Examples include prepaid pension costs or other amounts paid in advance that will provide benefits over a period longer than 1 year. Finally, we have net deferred tax assets. These arise when the company expects to recover taxes in the future due to temporary differences between accounting profit and taxable profit. Since the benefits are realized over a long term, they are classified as non-current. So, in summary, non-current assets represent the company's long-term investments and resources that support business operations and generate economic benefits over multiple years. They are not meant to be quickly converted into cash like current assets, but they are essential for sustaining and growing the business over time.
All these current and non-current assets and liabilities that we have introduced will be discussed in much more detail throughout Section A. Each topic will be divided into separate episodes so we can take one item at a time and explain it clearly with examples. This approach will make it easier to understand and remember, especially for students who are new to accounting and the CMA exam. By breaking it down step by step, you will get a strong foundation in how each component of the balance sheet works in practice.
Now let's take a closer look at property, plant, and equipment, or PPE. These are tangible assets that the company uses in its operations and expects to continue using beyond the current period. In simple words, PPE are the long-term physical assets that help the business produce goods or provide services over several years. PPE is recorded at its cost, which includes not just the purchase price, but also any shipping, handling, or installation costs required to bring the asset to a condition where it can be used. For example, imagine a company buys machinery for $50,000 and pays an additional $10,000 for shipping and installation. The total cost of the machinery will be $60,000. If the company decides to depreciate this asset using the straight-line method over 10 years, we simply divide the total cost by the useful life. So, 60,000 divided by 10 years equals a yearly depreciation of 6,000. This means each year, 6,000 will be recorded as an expense on the income statement, reducing the book value of the asset on the balance sheet. Once the asset is in use, the cost is gradually recognized as an expense over its useful life. This is done through depreciation for tangible assets, amortization for certain intangible components of PPE, or depletion for natural resources. Examples of PPE include land, buildings, machinery, furniture, equipment, and vehicles. It also includes leasehold improvements, which are enhancements made to leased property at the lessee's expense, and assets obtained under lease agreements. Even natural resources like gas, minerals, or timberland are considered PPE, but their cost is depleted as the resources are extracted or used. One important point to remember is that land is not depreciated, amortized, or depleted because it does not wear out or get used up over time. So, in summary, PPE represents the long-term physical assets that the company invests in to support operations and generate revenue over many years. Properly recording and depreciating these assets ensures the financial statements accurately reflect their usage and value. Now let's talk about depletion, an important concept in accounting for natural resources. Depletion is similar to depreciation, but instead of allocating the cost of a building or machinery, we allocate the cost of extracting natural resources like timber, minerals, oil, or gas. The idea is simple. Natural resources are limited, and as the company uses or sells them, the cost of those resources must be recorded as an expense gradually, instead of all at once. This follows the matching principle in accounting, where expenses are matched with the revenue they help generate. The total cost that will be allocated over time is called the depletion base. Think of it as the total investment the company made to acquire, explore, develop, and eventually restore the resource. This total cost is then spread over the period in which the resources are actually extracted and sold. There are four main factors that make up the depletion base. Acquisition. This is the cost of obtaining the rights to the land or property where the natural resource exists. For example, if a company buys land believed to contain oil, the purchase price or lease cost of that land is included in the depletion base. Exploration. Before extraction, the company often needs to explore the land to confirm that resources exist and can be extracted economically. Expenses here might include digging test wells, surveying the land, or drilling small sample holes. These costs are part of the total investment in the resource. Development. Once resources are confirmed, the company must prepare the land for extraction. This includes costs like tunneling, building wells, installing equipment, or creating roads to access the resource. These costs ensure the resource can be extracted efficiently. Restoration. After the resources are fully extracted, the company may have obligations to restore the land to its original condition or meet environmental regulations. For example, filling in mined areas, replanting trees, or cleaning up pollution. These restoration costs are included in the depletion base because they are part of the total investment required to use the resource. So, in simple terms, depletion spreads the total cost of the resource over the period it is being used, just like depreciation spreads the cost of a machine over its useful life. This ensures that financial statements reflect the true expense of using natural resources, instead of showing all the cost in one period, which could distort profit. By understanding depletion, new students can see how companies carefully match costs to revenues for resources that are limited and valuable, which is a key part of proper financial reporting. Now that we have understood what depletion is, let's discuss the methods used to calculate depletion. There are two commonly used methods: the percentage depletion method and the cost depletion method. First, we have the percentage depletion method. In this method, a fixed percentage of the total quantity of the natural resource extracted is recognized as an expense, regardless of the actual cost. For example, imagine a company extracts $10 million worth of oil during a year, and the fixed depletion percentage is 15%. Using the percentage depletion method, 15% of $10 million, which is $1.5 million, is recorded as the depletion expense for that year. This method is simpler to apply, but it does not always consider the actual cost incurred in acquiring or developing the resource. The second method is the cost depletion method. Here, depletion is calculated based on the actual capitalized cost of the resource and the quantity extracted. For example, suppose a company has capitalized costs of $1 million to acquire and prepare a property that yields 500,000 barrels of oil. If the company extracts 100,000 barrels in the first year, the depletion expense is calculated as 100,000 barrels multiplied by $1 million divided by 500,000 barrels. This gives a depletion expense of $200,000 for the year. In simple terms, the cost depletion method spreads the actual investment cost over the total expected quantity of the resource, ensuring that each unit extracted carries its fair share of the total cost. So, to summarize, the percentage depletion method uses a fixed percentage of revenue or quantity, while the cost depletion method allocates the actual cost based on the quantity extracted. Both methods aim to match the expense of using the resource with the revenue it generates, which is a key principle in accrual accounting. Now let's discuss intangible long-term assets. Intangible assets are assets that do not have a physical substance, but they still provide economic benefits to the company over multiple years. Unlike machinery or buildings, you cannot touch or see an intangible asset, but it can still be extremely valuable to the business. Intangible assets can be either purchased from outside or developed internally. However, there is an important accounting rule. An asset can only be recorded on the balance sheet if it arises from a prior transaction. This means internally generated intangible assets, such as internally developed research or ideas, are generally not recorded as assets on the balance sheet. For example, if a company develops a new patent internally, the research and development costs are usually expensed as incurred because no transaction has occurred yet. However, any direct costs associated with registration or legal fees to file the patent can be capitalized and amortized over the useful life of the patent. Some common examples of intangible assets include patents, exclusive rights to inventions, copyrights, legal protection for literary or artistic works, franchises, rights to operate under a franchisor's brand, customer data, information that can generate revenue, software, purchased or licensed software used for business operations, trademarks, brand identifiers, logos, or symbols, goodwill, the excess paid over fair value during acquisition of another company, brand, recognized market identity that provides value. Intangible assets are usually amortized over their useful life to match the cost with the revenue they help generate, just like depreciation for tangible assets. In summary, intangible assets may not be physical, but they are long-term resources that provide value and can play a critical role in a company's success. Now, let's move on to current liabilities. Current liabilities are obligations that the company expects to settle within 1 year or the normal operating cycle, whichever is longer. They are usually settled through the use of current assets, like cash or inventory, or by creating other current liabilities. In simple terms, these are short-term debts or obligations that the company must pay in the near future. Some common examples of current liabilities include accounts payable and trade notes payable. These are amounts owed to suppliers for goods or services purchased on credit. Cash dividends payable, dividends declared by the company that are yet to be paid to shareholders. Contract liabilities, obligations arising from advance payments received from customers before delivering goods or services. Deposits received from customers. For example, a security deposit received on a leased property. Short-term notes payable, promissory notes due within a year. Taxes payable, wages payable, and other accruals, amounts the company owes to employees, government, or others that are expected to be paid soon. Long-term obligations, callable at the balance sheet date. Sometimes long-term loans become current if the company violates a loan covenant or condition, making them immediately payable. Bank overdrafts, amounts withdrawn from a bank beyond the available balance, which are repayable on demand. So, in summary, current liabilities represent the company's short-term financial obligations, and managing them carefully is critical to ensure the company maintains sufficient liquidity and can meet its commitments on time. Now, let's discuss non-current liabilities. Non-current liabilities are obligations that are not expected to be settled within 1 year or the company's operating cycle. These are long-term debts or obligations that the company will pay over a period longer than 1 year. Understanding non-current liabilities is important because they reflect the company's long-term financial commitments and help assess its financial stability. Some common examples of non-current liabilities include long-term loans, loans that are repayable over several years, such as bank loans or financing for equipment or property. Bonds payable, debt instruments issued by the company to raise capital from investors, usually with a fixed interest rate and repayment schedule over multiple years. Pension obligations, amounts the company is required to pay to employees after retirement, based on defined benefit plans or other pension agreements. Net deferred tax liabilities, taxes that the company expects to pay in the future due to temporary differences between accounting profit and taxable profit. In simple terms, non-current liabilities represent the company's long-term financial obligations that support operations, investment, or employee benefits, and they are critical for evaluating the company's solvency and long-term financial planning. Now, let's discuss equity. Equity represents the portion of the company's assets that is owned by the shareholders. In other words, it is what the company owes to its owners after settling all liabilities. If the company were to be liquidated and all assets sold to pay off its liabilities, equity is the amount that would theoretically be distributable to the owners. Equity is composed of several key components. Capital stock. This is the par or stated value of the shares issued by the company. It represents the initial contribution of the owners. Additional paid-in capital. This is the amount contributed by shareholders over and above the par value of the shares. For example, if a share has a par value of $1 but is sold for $5, the extra $4 per share is recorded as additional paid-in capital. Retained earnings. This represents accumulated net income that has not been distributed as dividends to shareholders. It is essentially the profit the company has kept to reinvest in the business or for future use. Accumulated other comprehensive income. These are gains or losses not included in net income, such as gains or losses from hedging, derivative financial instruments, or remeasurements of certain assets and liabilities. Non-controlling interest. This represents the portion of equity in subsidiaries owned by other shareholders, where the parent company owns less than 100% of the subsidiary. Treasury stock. These are shares that the company has repurchased from its shareholders. Treasury stock reduces total equity because these shares are no longer outstanding and do not confer ownership rights. In simple terms, equity is the owner's claim on the company after all liabilities are settled, and it shows how much of the company is financed by the shareholders rather than creditors. Equity is a critical part of the balance sheet because it helps investors understand the financial health and ownership structure of the company. Now, let's discuss the benefits of the balance sheet. The balance sheet is not just a static report of assets, liabilities, and equity. It provides valuable insights about a company's financial health and performance. First, the balance sheet helps to compute rates of return. By analyzing assets and equity, investors and management can calculate how effectively the company is generating profits relative to its resources. Second, it helps evaluate the capital structure of the business. By looking at the mix of liabilities and equity, we can understand how the company is financed and whether it relies more on debt or shareholder funding. Third, the balance sheet can be used to predict the company's future cash flows. By examining current and non-current assets, along with liabilities, we can anticipate how much cash the company might generate or need in the future. Finally, the balance sheet helps users assess key aspects of a company's financial health, including liquidity, the ability to meet short-term obligations; solvency, the ability to meet long-term obligations; financial flexibility, the ability to adapt to financial needs or opportunities; risk, potential vulnerabilities related to debt levels, asset quality, or other factors. In simple terms, the balance sheet provides a snapshot of the company's financial position at a point in time, but it is also a powerful tool for decision-making planning, and evaluating performance. Now, let's discuss the limitations of the balance sheet. While the balance sheet is a very important financial statement, it does have some limitations that we need to understand. First, the balance sheet provides only a partial picture of a company's liquidity or financial flexibility. To get a complete understanding of cash availability and how the company manages its resources, we also need to look at the cash flow statement. Second, the balance sheet does not always provide the true market value of assets or liabilities. Many items are recorded at historical cost or book value, which may differ from their current fair value. Third, many valuable assets are not reported on the balance sheet at all. For example, internally developed brands, customer loyalty, or proprietary knowledge often create significant value for a company, but are not recognized as assets unless they were purchased. Finally, certain asset values are measured at historical cost, meaning they reflect the original purchase price rather than what the asset could be sold for today. This can make the balance sheet less reflective of the current financial position. In summary, while the balance sheet is an essential tool for understanding a company's financial position, it should be used together with other financial statements to get a complete picture of performance, liquidity, and value.
Thank you for watching this episode. I know this session looked a bit long, but remember, today we only focused on building your foundation for the balance sheet. We covered what it is, why it matters, and the basic structure, like current versus non-current items, how assets and liabilities are classified, and what equity represents. In the coming episodes, we will go through each item step by step so everything becomes super clear and easy for you. Please watch this lesson again if needed, make your own small notes, and make sure you truly understand the basics. Because once this foundation is strong, the next topics will feel much simpler and more fun. Take care, keep learning, and I'll see you in the next episode. Bye!